There is no investment that does not have its own risk. But the moment you're able to understand them and know, and the moment you're also able to mitigate them, then you're good to go. Market research is not a one-off. It's something you do every year so that you can take informed decisions. One example of the market risk is economy downturn. It can lead to vacancy. So we saw that happening recently. Inflation came in. Some people even said we're even in recession. Some people don't believe we're not in recession and all that. So we are both in inflation, recession as it is, and all that. That is really, really affecting the market. So you need to know it and know how you can mitigate it. And how can you mitigate it is for you to conduct a market research. It's possible the market was good this year. It does not mean that it's going to be good next year. We saw markets that were high in 2019, 2020. When the pandemic came, we saw people moving from some location to the rural areas, some to very isolated areas, and that was because of the pandemic, and some of them never returned. And that alone made some shifts. We saw some locations having declined population. So you need to conduct your market research. It's not a one-off. Market research is not a one-off. Maybe I just bought my deal, I'm done. It's something you do every year so that you can take informed decisions. So like this year now, on the two markets we are currently in, we are in the Dallas market and we're also in the Pennsylvania. We've conducted the market research on both. And that was because we're doing our budget. We wanted to understand what the market is saying versus our budget. So in the process of doing that, we have to do the market research. And doing that, we understood that things have changed. Market research is very important, and diversification of location. So why this is important is that when there's like this thing that I just mentioned now, that we're having a pushback in the Dallas market, guess what? In our PA market, we are seeing a reason to increase more. We're adding more to what we already have. So different markets, different opportunities. You don't have to put all your investment in one market. That's why we are in those two opposite markets, and we are playing with them because they align to what we are looking for. So diversification of location is important. It can save you from some risk. So when one market is doing bad, the other one is doing well and all that. So you can go like that. Invest in growing markets. Like some of our deals are in the tertiary stroke secondary market, and it's intentional. And because we are seeing some significant growth in those areas, and the pandemic made it so. We saw people leaving the cities and going to the rural areas to stay, and that has brought about growth. And if there are people there, you see companies coming in there. So in the secondary tertiary market that we are in, we are seeing growth. Companies are moving down there. So it's those kind of markets you want to be in, the ones that are growing or have the ability to grow. And if you don't do your market research, you will not know. So that's for that. Tenant risk. Before I go there, for that market that is growing, it's important that you position yourself before the growth is achieved. If you've done your study and you know the market is going to grow in the next 5 years, it's important that you quickly enter that market so that you take advantage of when the market is at its lowest, so that when that growth happens, you are reaping from it, and maybe that's when you're exiting or you are refinancing or something. So that's for that. So the tenant risk, right now we are seeing tenant unexpectedly vacate, causing lost runs and repair costs. So you need to evaluate your tenant risk. Like some of you know, one of our deals that is a student housing, we had to reevaluate the tenant risk. It was high in turnover. That means every year the students will leave and we will have to renovate the property with about 100,000 or more. And that is a risk that if you don't factor into your budget or into your underwriting, that can throw you off. Typically, turnover cost is not that high, but because it's student housing, it's like you're doing a renovation on the house. So these are risks you need to look at. Tenant risk, like I said, with the new president that's coming in, you need to start reevaluating, screening your tenants. If you're not checking their status and all that, that might be something you need to check. If you were not checking their job, you need to ask them what's going on with their job. Do they even still have a job? You need to start asking questions. If their credit score before was maybe you are accepting 580, like 2 of our properties were accepting 580 as the limit. Last week during our meeting, we just increased it to 650. That means we don't want anybody that is below 650 on that property because of the risk now involved. So these are things you want to do. And the reason why you're doing that is to avoid delinquencies, vacancies, and bad age receivable, bad debt. You want to avoid all that. And then offer competitive amenities properties, this is a time you want to keep your tenants, you want to now bring in things to retain them. Maybe your competitors have swimming pool, you might want to do that, or they have grill area, you might want to do that, or they have a washer and dryer center, laundry room, you might want to do that. So you need to know what your competitors are doing so that your tenant will not leave your property and go somewhere else because they don't have the amenities that will keep them there and all that. Then your property manager must be proactive. Like one of the things that property manager is doing is that they are engaging the tenants to know how they are doing. And in the process of knowing how they are doing, they are asking them indirect questions about their job. Is everything going on well? And they're doing that as an intentional question so that you know who is leaving. And they're asking questions like, are you traveling out for the Christmas holiday? Are you coming back? It's a very friendly question, the way they ask it, but really it's for us to take some decisions. So you need to have a proactive property manager on site. Operational risk, this one I cannot overemphasize the importance of having the best of the best property management company. This one alone can kill your deal entirely. Having the wrong property manager, not just having them to stay too long is as bad itself. So if you realize that you got a bad property management company, the earlier you take them out, the better for you. So you don't want to leave them to stay an additional 1 month or 2 months or 3 months, because the more you do that, the more your property is dying. And guess what? Remember I said something. Your KPI, when you're monitoring your property, it starts from the weekly. So if things are happening every week and it's bad, it will trickle into the monthly. And before you know, it has affected your 1-year plan. So you want to avoid that from happening. So that's why I'm emphasizing that the earlier you take them out, the better for you. If you can remember, before we asked our property management company to leave, they only stayed for 2.5 months. The error that they did till now, we're still feeling it.
Yeah.
Just 2.5 months. The mistakes they made affected our 1-year returns significantly. The time we replaced them was the time where you don't replace property management company, because that was the holiday period and that was a period we're renewing for the new year and all that. That was a very risky time to do that. But anyways, we just had to do it, but it affected us. Once you notice they're not doing their job, fire. Don't give them that wiggle room. If not, it might affect your entire returns for that year or even everything. So you just want to be careful when you're doing that. So I have 3 more to go and we can ask questions if we have. Financial risk, rising interest rates, increased mortgage payment. You want to be sure of the loan you are getting. Like I said, you also want to keep reserves. You have to keep reserves because we are seeing insurance going high. We are seeing property tax going high. Somebody brought a deal to me. I wanted us to partner on the deal, but guess what? Actually, the deal was good, but I left the deal because of the property tax was not properly accounted for. And when I mean it was not properly accounted for, I mean that we called a tax specialist to give us a projection of what the tax will look like. And based on that, they did not account for that alone. And they were just assuming that, no, it's not going to happen. And I'm like, oh, no, it's going to happen. If the tax person is telling you this will happen, I rather go with that and know that maybe in the future it doesn't happen, but I have reserve for it, than not even having that reserve and it happens, then I'm in deep water. So based on that, I had to withdraw my steps backwards. So you want to be careful about the debt, the reserve, and the underwriting must be conservative. I see people doing their rent escalation. That is, they're projecting that next year they're going to increase rent by 5%, by 8%. I've seen 14%. I saw 14% 3 weeks ago. And I'm not joking, guys. For 2025, 2026, 2027, I was like, really? So there's a 14% and everybody is not running to that market. Why are we not all there? So, and the market did not tell me so. And regardless of even if the opportunity is there, be conservative. Why are you not saying 7%? What if you're not able to achieve the 14%, which I know is unlikely for you to have that? It's only a few markets, but it's rare, So I'm not saying it's impossible, but not even in this period. That was too aggressive, very aggressive, and no. So legal and compliance risks, tenant sues over legal violation. You also want to be sure that your apartments are up to code. There are some tenants that know their rights and they're looking for every wiggle room not to pay their rent or to sue you to get money. So you have to be sure that you're in compliance with it. One of the property, the tenants did not report to the property manager that their bathtub had some issues that was like an hazard. They did not report to us. They went straight to call the city. They called the city and reported. And that was like, and the property manager was like, but we're here. Why didn't you tell us. We're not in your house. We don't stay with you. If you don't report this, how do we know? And the good thing was that property manager and the inspector that comes, they've created some rapport. And the lady said, I'm giving you 24 hours to do it. And the property manager just called me and said, Bibi, we need your approval. Should we do it? I said, go ahead, please, hurry up, do it. It cost us double because it was an impromptu repair. But we had to do it because some tenants are crazy. So you want to be sure that your property is up to code and your reputational dam, everything, So you also want to consult with a lawyer if you have to. Obtain comprehensive insurance. We are seeing things happening in different locations, like the hurricane that happened in Florida and in North Carolina. These are real issues, guys. I don't know how some insurance companies are even ignoring it. Some of them will not respond until many years. Some of them will have to go to court. Some of them are saying your insurance does not have flood insurance. So I'm not going to cover it. But the place is not a flood zone. Why should I get a flood insurance? Flood from nowhere just came and now they're in that. So you need to have a comprehensive insurance. The last one is exit strategy. The market softens, making it hard to sell at a profitable price. So like I said, this is not a seller's market. Most people that are selling, some of them because they've gotten to the peak, they need to exit. Some of them are selling because they are not profitable. Some of them are selling because their loan is due. So most deals we are seeing are falling under those categories, and this is the time for anybody to buy and not actually the wise time to sell. So we also need to plan multiple exits. Like the deal that we currently have, we have multiple exits. We have an ability to refinance, to sell if we want. We have also the ability maybe to do 1031 exchange, different exit strategies that we can do on it. So you need to have multiple exit strategy in case something happens. And you need to understand the cycle. The market cycle is like this, just like the name implies. You need to know when the market is up on the cycle, what you should do when it's by the side, and when it's down in the lowest point, what are the things you need to do. And remain flexible. Yes, you have your business plan, your goal and all that, but you need to ensure that your business plan is also flexible. So in case an opportunity comes, you take it. Or in case you see problem coming in front, like if you see that your market is going to decline, let's say the location was good, but you did a market research and you're seeing a decline happen in some few years. Like some markets, they might experience some decline in construction. If construction workers are leaving, some properties might face some challenges, So you want to understand and be flexible and just take advantage of the opportunity and run if you have to run. In summary, that is the end. It's just for us to identify the different motives. There is no investment that does not have its own risk, but the moment you're able to understand them and know, and the moment you're also able to mitigate them, then you're good to go. So thank you, everyone. If you please, over to you.
Dara had a question. What percentage of operating reserves should be considered in underwriting?
Yeah, so there's no fixed amount. It just depends on the deal. So typically the seller will take a reserve. The seller takes between 3 to 6 months reserve on the insurance and taxes, and they hold on to it. Sometimes for the entire period of the deal, and sometimes they give you a clause that if you are able to consistently pay your bills, nothing happens, after a few years, they'll give you back and all that. So that reserve, you should have it. And you should also have your own reserve for emergencies, for capex, for different things. So it's not one size fits all situation. It depends on the deal and the risk involved. So for a C class, I will advise more. For an A class, maybe a little, just normal. For a B class, more than an A class. And the reason why I'm saying that is because an A class property is brand new or almost new. The tendency for things to break, it's not impossible. It happens, but not as frequent as an older property and all that. So you might want to reserve more on older property. But in a case whereby you're doing a lot of capex, that means you are replacing a lot of items. Fine. That means you have provision for that. But that does not negate the fact that you should not put some reasonable reserves down at all. Yep.
I have a question, maybe a little off the grid from underwriting, but as far as, trying to capture risk before it gets too out of hand, you mentioned somebody who didn't report the problem. They went to the city instead. Have you guys ever heard of maybe an attorney drawing up something for the tenants to sign, like specifically wording them not to do that?
No, you can't do that. Tenants have their right and landlords have their right. So you need to understand your right and the tenants to know their right. right. Tenants know their right, really. Many tenants know their right, but they're just waiting for the opportunity to use it. So as a landlord, you are trying to be on top of it. Only few places you see landlords treating tenants very wrong. I went to a property to inspect. If I know you can remember that we saw a lot of roaches.
Yeah.
So we wanted to buy the property. The LOI was accepted, but I was not ready to sign until I see the interior. So luckily for us, a tenant was outside, and a tenant came to meet us and was like, "Hey, I like you guys. I like." We were like, "Oh, that we came here to see the property, but they did not allow us. Can we see yours?" He said, "Oh yeah, sure, why not?" That was the best thing that happened to us. We went there. The entire ceiling was down. The whole house was wet. The water from the first floor was dropping on the ground floor. Roaches was everywhere. Everywhere, every place, everywhere. They had 3 kids in that
3
house.
kids, yeah.
They will be eating and roaches will be around the food, be climbing on the food. I've never seen such in my entire life. And I asked the question, I asked the tenant, something like you're supposed to report it. And the tenant was like, "I don't want any problem. I don't want any issue." I was like, "What? This is bad. This is not the one you say you don't want any problem, you don't want any issue." But because we raised an alarm, the owner withdrew the property from the market and did some repairs. Lately, I just saw the property out again, so tenants know their right and you can like shun them not to talk and all that. Just do your own part. It's pretty easy. Ensure that your house is in compliance, the codes are met. That's what the maintenance and the property management company is there for them to go around and inspect and see anything that is breaking or something that is going to cause an hazard. But just that some landlords are just looking for more money and they're not maintaining the properties. That's the problem.